David mentions that he has a long call on SPY that expires next June. There is an ex-dividend date on 12/17 and then again in 20,002. What is the risk there in holding that longer term call, or say a leap call, through the ex-dividend distribution? David, there's not much. Okay, you hear these things about how the stock pulls back the amount of the dividend, but that's not really going to fluctuate the implied volatility. SPY here. Let's take a look at the chain real quick, and I'm going to go to June. You said June, so I'm assuming you mean 217 days out. Not quite a leap there, but I want to be just in calls. I'm sorry. There we go. And I'm going to take an in-the-money call, reasonably priced. Let's see here. That's pretty decent. Okay, I'll just stick with the 455. We'll call midpoint 32.60 for right now. Okay, so at 32.60, you've got an ex-dividend date coming up on 12/17, David. Okay, and let's just go to that research tool here. And we're a dividend of about, let's call it 145. Just keep the math simple. Yes, it's only 142, but let's call it 145. All right, now, as we did before, let me clean some of this up here real quick. We're just going to take some of these windows out that we're not using anymore. And we're going to go back directly to that custom spread tool. And I'm going to put in that if I bought that 455 June call today, I know it's not the one that you're in. I know it's not at the same price that you're in. I should have kept the screen paused so you guys didn't have to see all the scrolling here. My apologies. Let's go ahead and put that in. And we said we were going to have a cost basis of 32.60 at midpoint. That's great. All right, I'm just going to buy one, $3,260. Again, instead of buying the stock at the current price, or buying the ETF here at 467.27, $46,000, I'm buying the right to buy it at 455 for only 32.60. Now, if I expect the stock to drop by $1.50 in this case, because of this scenario, let's say it stays the same. I'm sorry, I lost my train of thought there, David. Let's say it stays the same, and we lose $1.50 or $1.45. Let's just call it $1.50 on 12/17. What would it look like on 12/18? Okay, volatility remains the same. It's not going to change much. And we go down to 465.70. That'd be about $1.50 from where we are now. And this happens on 12/20. I'm sorry. Here we go. Literally, I'm just losing that amount. Am I really losing it though? Because I still have another 210 days to go. No, 180 days to go. My purpose here that I bought the call is because I'm expecting this to still continue to move up in price. I'm not bearish on it. $1.50 hiccup on a long-term option like this that's in the money is not really a big deal. And by the way, if the market is up on the ex-dividend date, some other news came out that's not related directly to SPY, just related to the market as a whole, David. You could pay the 150 dividend and SPX could still be up 3 or 4 points, could be up 5 or 6 points, could be up 10 points, depending on the news. If news is negative, it could drop 10 points, 20 points. And some of that might include the $1.50 for the dividend payment. Some might not. Okay? That's still the market condition you're kind of considering. Fernando, he says, can you explain the concept of call and put parity? Okay, you can see this at any time, Fernando. Just go to any option chain. I'll go to Ally because you also asked about dividends and how this affects it. So we'll take a look. Well, you look for, and is this a good one to use? 50, 58? It's okay. Probably there's other ones that are probably better, but we're just going to stick with this. And what I'm looking at here is time value. So the ask time value on the 50 strike call 7 days out is 57 cents. The ask time value on the 50 strike put is 57 cents. Okay, so why is this at 108, 115? Well, that's because it's 58 cents in the money. But the put call parity is that the general ask time value or the time value in the positions should be about the same. Let's go out to December. Okay, time value here. I'm sorry, let me just do December this way so we can see the columns a little bit better. Looking at the ask time value, 171 at the 50 strike, 1672. We're pretty much there. A little bit different here as we go in the money. 59 for the call, 68 there. 130 to 130 on the 49. 107 there. So that's pretty much what you're looking for. And this is a dividend paying stock. However, Ally's next dividend, if I'm not mistaken, is not till January 21. Why is that? Sorry. That's important because I need to go to February now or March. February would have been better. But you still see there's not much of a disparity in these positions. They're pretty much the same. Could I justify that this difference of 8 or 9 cents between the time value ask on the call or time value bid on the call and the time value bid on the put, in this case of 7 cents or so, could that be related just to the dividend payment? No, it's a little higher. It's about 25 cents. So you don't really see too much. And that's also due to implied volatility. And as you know, most dividend paying stocks have a lower implied volatility. Okay? Dividends, in my opinion, depending on the stock. Okay, I'm talking about a normal dividend payment with a low volatility stock. You're talking about Apple, you're talking about SPY, we're talking about this here. A dividend, you don't see that really affect the put-call parity. You really don't. Now, on a REIT, you might see that. Something that pays a 12 or 13% dividend. That's when it comes into play. When you look at the out-of-the-money call, 35 days out, 45 days out, 50 days out, and the price is 5 cents on a $20, $30, or $40 position that pays a 20% dividend, the put also has a low time value on it as well. But you see the parity there when the dividend gets really high, 7, 8, 9, 10%. You don't commonly see it on most stocks. With this kind of volatility we're talking about. So let's go to IBM. Oh, I'm sorry. It would help if I typed it right? And I don't know when their next dividend is, but let's do the same thing. Let's go out to January just in case. At the money, time value 260. All right, here it's about 294. That's not too bad. So here's about a 30-cent difference on IBM. That's actually pretty interesting. It's 30 to 40 cents. When is their dividend? Oh, it just passed. Okay, it's 11.9, so it's not going to be until further beyond that in that case. But that is quite interesting. This is a little bit more. It's also a higher price stock, Fernando. So you're seeing a 30-cent, 40-cent difference in the put-call parity in this case. And as you go deeper in the money, out of the money for the calls, in the money, they start lining up 199 to 201, 91 to 101 for the time values, 53 to 66. That also is dependent on IV range. See here, there's zero implied volatility because there's been zero activity. So that is maybe affecting the prices of the ask value as well. Okay. Let's do a covered call search real quick. I can't think of the one that Ernie traded years ago for a married put test with a high paying dividend. So we're just going to look for stocks, let's say between $10 and $80. I'm looking for some of these REIT positions with a dividend of at least 10%. And I just want to be one strike out of the money. All right, don't have dividends selected. That's okay. That's a high implied volatility. Masabi, 24 CVR, Rio Tinto. I'm going to have to add it in, Fernando. I do apologize. I need to see it, what I'm looking for. Masabi is a 12. I didn't realize. I want to use this one, though. No, I'm going to stick with Masabi. It's a 25, 145 call, dividend yield of 12%. Once again, just go to the option chain. Let's stick with that standard December expiration. And again, change it to calls and puts to see our values. The at the money, okay, the at the money, it's out of the money, but the 25 here, the ask time value is at 175 and the puts at 188. It's not too different. It's only about 13 cents. The call here at 287, ask time value, our put, okay, there you go. So now you're seeing with an in the money call, expecting the dividend to drop here and the put price as well. Now you're seeing that disparity that you were looking for. And again, where? And it's opposite. As you go in the money with the puts, look, the ask time value is at 173. We're out of the money calls are 50, 30, 20 because of the high dividend. This is where I think you're talking about the discrepancy you see. Don't really see it on lower volatility, normal dividend paying positions, 2, 3, 4%, Ally, IBM, Apple, SPY. You see it when you get into these really obscure dividends, 10, 12, 9% dividend payments, REITs, and other things along those lines. You start to get that huge disparity on the positions. I mentioned the reference that Ernie traded. We were getting a lot of customers, Fernando, and I think you might have been around during this time. It was about 4 or 5 years ago, I think, or you might have just started rolling around then. In any case, Fernando, what do we do when we set up the married put? Hey, I look for a stock position that I'm going to buy the stock, buy a put that's at least 6 months out in time, control my risk to single digits, 8, 5, 4, 7%, somewhere along those lines. And, so I'm taking a low risk. And everyone's saying, well, look, why don't I do this married put position you're talking about that you guys are advocating? And why don't I improve on it? I'm going to do it on a stock that pays a 12 or 13% dividend. So if I buy a year out put, the dividend payment is going to more than cover this 6% risk, and I'm going to have a 6% profit, and anything I get in between is just gravy. And this is what you're referring to, Fernando. This is what we just saw on that Masabi chain. When you go with the in-the-money puts, the time value of those in-the-money puts is inflated to account for the dividend. So I'm going to leave everything here, but I'm going to put my risk between 2 and 12%. No, I'm going to go 2 to 15%, leave everything else the same. And we're going to take out the list that we use for our default search. I'm going to take out the fundamentals here. And let's go to 11% dividend payments. And I'm sure that'll happen, but I got to take out the volatility. And I've got to take out the stocks trading above the 50-day moving average. Let's see what we get. CVR came up. That was the second one on our list, but Masabi did not. Why didn't it come up? It has a dividend, right? It has a dividend greater than 11%. I took out all the other features that would have restricted it, 9 to 100. Maybe it doesn't have an average stock volume greater than 300. Or the risk is higher than 15%. That's a possibility. Let's see if we get Masabi in there now. Nope. Okay, I'll look it up individually. But what are we talking about? Look, this is the June option, Fernando. It's not even a year out in time. CVI. Now I'm in married put. I'm not in covered call. I'm sorry, folks. I got to add dividend back in. There we go. CVI. This was a 10, I thought. Okay, that's not right. But in any case, I don't know why it's showing 57.3%. But here's a good example. Sutter Rock Capital. Let's use this one. 1552. In the money, 17.5 put, only 200 days out, is a 12.1% risk. And it's got a dividend of 12.8%. I'm not getting that full 12.8%, am I? I got to go out to January on SSSS. And this is what Ernie tested. He went a year out. He went a couple of strikes in the money on the married put on a stock that paid a 13% dividend. It's one of the REITs there. He held it for almost a full year. He was hoping to be able to get income against the position because essentially he was saying that, yeah, if I hold it all the way to the end of the year, I'll get the 13% dividend on these positions. I only had a 13% risk, so anything I get above that is gravy. There's no premium because of the dividend. There is nothing here. You can't risk getting assigned because of the higher cost of put. He'd have to sell a 17.5 or the 20. And on his example with a 13% dividend, when the stock, it was around this same price. I think he got in at 13 and bought the 15 strike put. And when the stock got up to 15, he looked to sell the 15 call. Even 40 days out, it was 5 cents, 6 cents. The put wasn't losing too much money. He was getting the dividend, but he wasn't making more. At the end of the position, he closed it for almost break even after 11 months. And he did sell calls twice against it. And the stock stayed around the same price. That's where the dividend comes into effect, is when you see a large dividend The in-the-money puts usually take account for it. And you see little to no premium at all on the out-of-the-money call positions. And that's how it affects it. I just wanted to remind everyone, of course, that today's material and my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Based on the example and the discussion we just had, Ernie and I never suggest doing a married put on a high dividend paying stock because you don't see any extra profit on the position usually. Trading a position, a married put on, say, Ally or IBM or something with a 2, 3, 4, 5% dividend is a good play, usually done with about 10 to 20% of what I allocate to the married put part of my portfolio. But I'm not making a suggestion to do that. We talked about the bull puts a little bit, but I'm not necessarily opening a new position on the 3 bull puts we saw today that were historical from 1025. Any stocks or options should not be taken as recommendations or trading suggestions. Options, as we saw today, do involve risk and may not be suitable for all investors. We saw the portfolio tool in the beginning. We looked at the rollout opportunities and setting alerts. We walked through a couple of the search screens today as well. We looked at a couple of the signature tools, believe it or not, and we did take a look at the back test as well. Well, if you like any of these tools and you see like how they can help you increase your investing performance and ease of managing and tracking and finding new trades, just take a 14-day free trial at any time. Just go to powerup.com, put in your name and email address, and you'll have full access to the site for 14 days. After that, the subscription levels, monthly subscriptions start at just $45 per month. You can cancel at any time. There's no contractual obligation. Free coaching sessions are available during your trial and on all level of subscriptions, and you can upgrade at any time as well to the different higher levels. We also offer free education. You can go to Power Options, take a look at our webinars page. We got a lot of detailed information and presentations such as today on different option strategies using the Power Options tools and more. Or you can also check us out on YouTube, as we did a little while ago, showing some of those earlier presentations on management techniques, the rolling the covered calls, and the poor man's covered calls candidates as well. Now, if you do think of any other questions, send me an email at any time to support@powerup.com or support@radioactivetrading.com. Remember, you can also call us during market hours at 302-992-7971. Of course, current trial members and subscribers, you can schedule one of those free coaching sessions at any time. That's essentially a 35 to 45-minute phone conversation with myself or Ernie, walk you through the tools on the site and answer any questions that you have.